So one thing I forgot to mention on the setup is when you're setting up the worksheet, make sure you put net income as the first item in the operating section. That's a good idea for the setup. Okay, I'm focusing on just the current accounts, and I'm just showing the current accounts here because that's what I have room to do. So what we're going to look at is we're going to say, okay, we have our beginning balance and our ending balance. What must have happened to get us there? Well, cash started out at 22, it ended at 63. That means we must have had a $41,000 increase, which we would show by a debit up here in the top section to explain what happened. Now we're going to go way down to the bottom, way below what I can show you here, and you're going to have where it goes totals, change in cash, and totals after, at the very bottom of the statement of cash flow effects section. You're going to have a thing that says change in cash. Okay, so that's going to be way down at the bottom, and this is the best I can do with this here. And where we entered this as a debit up here, it's going to go down and it will be a credit down there of the 41,000. Okay, accounts receivable started at 76, they ended at 85,000, so that's a $9,000 increase. So we say, oh, we must have had a debit there, an increase of 9,000. Now we're going to go to the operating section. If you remember from the classifications, anything that is involving the current accounts, current assets, current liabilities, or is on the income statement ends up in the operating section. So we're going to go to the operating section and just tell what happened. And you can just do something like this. We had an increase in accounts receivable. Okay? Now, it was a debit entry up above, so we make a credit entry in the statement of cash flow effects. Okay, inventory declined. It was 189, it went down to 170. So that is a $19,000 decrease, which would be a credit. So 189 minus 19 explains the 170. Again, we go to the operating section, and we say we had a decrease in inventory. So we just tell what happened, and then we make the opposite entry that we made up above. So it was a credit up above, it's a debit down below. And what these entries down below are giving us is what was the impact on cash of the changes up above. So, and I think I'm going to stick with the mechanics of this right now, and we'll come back to, you know, why this makes it a lot easier later. Okay, so then your other current account is your accounts payable. Now this is a credit balance account. It went from 47 to 39, which means it decreased, and we know that we show a decrease in a credit balance account, so we must have had a debit of 8,000 here. 47 minus 8 gives us 39. And we just say we had a decrease in accounts payable. Okay, and we made a debit up here, and so we make a credit down here. Okay, so that takes care of all of the current accounts. The current accounts are the only ones that we can do what we've just done. In other words, what's the beginning, what's the ending, take the difference, make one entry up here, make the opposite entry down below. These are the easy ones. Then we get to all the rest of the accounts where we're basically going to have to be recreating journal entries, you know, either in our heads or on paper, and entering them more or less as is. So for all the other accounts, we cannot necessarily just check the beginning and ending balances. We have to go to the additional information and work out what must have happened. Okay, so that's what I'm going to stop right here and let you sort of catch up with the current assets, current liabilities section, and I'll do another podcast on investing and financing sections.